Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at our own discretion. And welcome back, everyone. Today, Monday, September 8th, 2025, we are diving straight into, well, a really dynamic market landscape. We're going to try and dissect the latest moves in global currencies, understand what's happening with equity performance, and really drill down into those key economic indicators shaping things. Our goal today is to give a concise but, insightful summary of the overall market. We'll focus particularly on the forces impacting the U.S. and European markets.
Yeah, it feels like a market really in flux right now. We've got these political shifts, big ones in Europe and Asia, sending ripples through currencies. And at the same time, central banks, especially the Fed, are, let's say, grappling with some conflicting economic signals.
Exactly. So we're here to try and connect these dots, these seemingly separate events, into a clearer picture for everyone listening.
It's definitely a complex tapestry, isn't it? Based on the prepared resources, we are seeing this significant mix of political turmoil on one hand and shifting economic expectations on the other, both influencing global markets. And what's really interesting, I think, is that futures across Europe actually started positive this morning.
Despite everything going on.
Yeah, despite some really significant political developments unfolding.
Yeah.
It suggests the market is maybe trying to find its footing, perhaps already pricing in some of these well-known unknowns.
Okay, well, that takes us straight to France then, a really pivotal moment there. Prime Minister François Bayrou faces that confidence vote today. And various news commentary seems to suggest it's widely expected to lead to his government collapsing. This isn't just politics, right? It raises serious questions about France's massive debt load, how any new government tackles budget tightening. From your view, what are the maybe broader implications here for European financial stability?
Well, what's fascinating is that the immediate market reaction, French stocks, the euro versus the dollar, Euro USD, it's been somewhat subdued.
So, priced in mostly?
It seems largely priced in, yeah. But the longer-term fiscal uncertainty, that's a substantial concern. Our sources highlight that, look, if nothing changes, France's debt to GDP could hit 125% by 2030.
Wow.
Yeah, 125%. That's not just a statistic. It positions France as a significant fiscal risk within the Eurozone. It could constrain their influence on EU policy, raise borrowing costs, potentially not just for France, but for the whole bloc.
So a real ticking clock for whoever comes next.
Exactly. Difficult decisions needed.
Okay, let's shift gears across the globe. Japan's also making headlines. Prime Minister Shigeru Ishiba resigned, kicked off a leadership race. Now this one's interesting. PM resigns, and we see a weaker yen but a rally in Japanese stocks. Can you walk us through the market logic there? Because that might seem, well, counterintuitive.
It absolutely can seem that way. The dynamic here is mainly driven by expectations. Expectations of potential fiscal stimulus from a new leader, plus probably delayed monetary policy normalization from the Bank of Japan.
Okay.
So investors are watching the contenders closely. Some are known for, let's say, aggressive easing and loose fiscal policy. Others maybe represent more continuity. The LDP is expected to decide on the election date tomorrow, Tuesday.
So it creates a dilemma for Japan.
It does. A weaker yen helps exporters, sure, but Japan relies on imports. So sustained weakness could mean inflation, maybe forcing the BOJ's hand sooner than a new leader might want.
Right, so two major political shifts, very different market reactions. Okay, we've seen how politics is reshaping things. Let's zoom in on how this plays out in currency trading, starting with Euro USD. Current data shows, as you mentioned, only slight movements. The euro seems relatively unaffected by the immediate French crisis. Why is that, especially with that concerning debt picture?
While connecting it to the bigger picture, analysts cited in various news commentaries suggest the ECB, the European Central Bank, might only step in if bund spreads widen significantly.
Bund spreads being the German yield versus others.
Exactly. A key risk measure. Maybe if they widen to 100, 120 basis points. ECB President Lagarde is likely to be cautious, wait for a political resolution rather than jumping in immediately.
A wait-and-see approach, then?
Seems likely, which might explain the euro's resilience for now. But there's a risk, right? Delaying intervention could just let spreads widen further, creating a bigger issue later.
That's a fair point. A delicate balance for the central banks. Okay, let's turn to the dollar-yen pair, USD-JPY, a big focus for us. The yen has fallen, weakening towards 147.80, even breached 148.5. Is this purely Japan's internal politics, or are U.S. factors involved too?
It's really a combination. The yen weakness is primarily down to that political uncertainty in Japan we talked about. It fuels expectations of continued easy money, maybe even more stimulus. But it's not entirely isolated. The two-year swap market suggests only a modest, non-aggressive rate hike at best from the BOJ this year. So that tells us the yen's direction is also heavily driven by the dollar's strength and, U.S. macroeconomic factors, not just internal BOJ plans.
A push-pull from both sides of the Pacific, then.
Precisely.
Okay, from currencies, let's bring it back home, sort of, to U.S. equity markets. They're showing some interesting moves this week. Futures for the main indices, S&P 500, NASDAQ 100, Dows, they're seeing a positive start, recovering from what was called a disappointing Friday.
Yeah, bouncing back a bit.
As seen in resources from finviz.com, data around 7.00 a.m. ET showed S&P futures up 0.22%, NASDAQ 100 up 0.38%, Dow up 0.15%, and this follows that weaker U.S. labor report on Friday.
Right, but despite that positive start for the futures, if we look at market breadth again from finviz.com, it's more of a mixed picture.
How so?
Well, about 52.7% of stocks are advancing, but 43% are declining. What is positive, though, is that 73.1% of stocks are making new 52-week highs versus about 27% hitting new lows.
So underlying strength in some pockets, maybe, suggests a selective rally, not broad-based.
Exactly. Hints at a selective rally.
And these individual stock stories often highlight bigger trends. For instance, reports say Tesla's U.S. market share dropped to a near 8-year low in August. Really spotlights the EV competition heating up. Conversely, the Dutch chip giant ASML is making headlines. A reported $1.3 billion euro stake in a French AI company.
Ah, interesting.
Yeah, that kind of strategic AI investment shows how even established tech giants are positioning for the next wave. Could give ASML shares a lift after being down over the last year.
And we're seeing broader sector moves tied to these themes too, right? Oil majors are up in the OPEC Plus news, which we should touch on.
Yeah.
Gold miners gaining as gold nears record highs. Clear safe haven demand.
Yeah, definitely.
What's important here is how these individual stories weave into the overall market narrative. Gives us clues about where money's flowing, even with these big macro forces at play.
Okay, we've looked at politics, currencies, some equity moves, but what's really driving things underneath? That brings us to macro indicators and, crucially, the Fed outlook. We always watch the CME FedWatch tool for FOMC rate change odds. After that recent labor data, the market's pricing in almost 3 rate cuts by year-end.
3 cuts, yeah.
And even a small chance of a 50 basis point cut soon. Is the market maybe being a bit too optimistic here, especially given some other data?
That's an excellent question, and it highlights this real tension when you look at the labor market versus inflation. The non-farm payrolls data, weak headline, downward revisions, June even turned negative. That definitely fueled rate cut hopes.
Sure it did.
However, the unemployment rate, 4.3%, is still technically within the FOMC's definition of full employment. That kind of challenges the need for really aggressive cuts.
So the Fed has to balance that, a puzzle for them.
A real puzzle.
And adding to it, inflation reports are center stage this week. PPI, the Producer Price Index, and CPI, the Consumer Price Index. Headline CPI expected around 2.9%, but core inflation might stay stubbornly above 3%.
Yeah, that core number is key.
What should we really focus on within these reports?
I think we need to pay close attention to the impact of tariffs on goods inflation versus potentially disinflationary trends in supercore services.
Supercore services, like rent, healthcare, the sticky stuff.
Exactly. Those less volatile elements that tell us more about underlying inflation trends. If tariffs push up goods prices while supercore cools, it really complicates the Fed story.
Okay, good point. And to gauge sentiment in all this, we always look at CNN's Fear and Greed Index. Now, the calculation is complex, 7 indicators, but what matters is what it's telling us about the market's, let's say, emotional pulse.
Right now.
Right now, with worries about job growth stalling, unemployment at its highest since 2021, the index is signaling increased fear.
Which can sometimes hint at market bottoms, or at least widespread caution.
Exactly. It helps us understand the psychological backdrop to all these economic and political events.
Precisely. It's a truly intricate balancing act, isn't it? Navigating these global forces needs constant watching, and understanding the emotional side is just as vital as the hard data.
Okay, so what does all this uncertainty mean for safe havens, for energy? Let's quickly highlight key commodity market moves. First, oil. OPEC Plus agreed to another modest production hike, about 137,000 barrels per day from October. Various news commentary notes this came after a super brief, 11-minute meeting.
11 minutes, wow.
Yeah, signals a potential shift maybe from defending prices to expanding production, though actual increases might be less due to capacity issues for some members. Crude futures are up about 1.76% this morning, around 7 a.m. ET.
Okay, and moving to gold.
Gold prices are near record highs. Futures up slightly, 0.05%, around the same time, 7 a.m. ET.
And that surge is attributed to those Fed rate cut bets we talked about, plus maybe some worries about potential damage to Fed independence from the Trump administration.
So it underscores that link between monetary policy, politics, and commodity prices.
Definitely. Gold acting as that traditional safe haven, signaling unease about both the economy and political stability.
And what about treasuries? The other traditional safe haven.
We're seeing yields down across the board, 5-year, 10-year, 30-year. Reflects some of that safe haven demand and, of course, those persistent Fed rate cut expectations.
Okay, number.
Around 7 a.m. ET, the 10-year Treasury yield was down 2.16%. The 30-year down 2.03%.
So the bond market is clearly reacting to both global jitters, France, Japan, and the domestic rate outlook, pulling yields lower.
Consistent with that flight to safety we often see when things get turbulent. Investors looking for stability.
Okay, as we start to wrap up this deep dive, let's look at the week ahead, using the economic calendar from investing.com, because it looks like a busy one. Today, Monday, September 8th, that French confidence vote we discussed. Key political event.
Then tomorrow, Tuesday, Apple unveils the iPhone 17. Always captures attention, especially in tech.
Wednesday brings crucial U.S. PPI data, fresh inflation insights there.
And Thursday looks huge. We get the ECB meeting, a major central banking highlight alongside the U.S. CPI data release.
Wow, yeah. Those two together could really move markets. Clues on European policy and U.S. inflation trajectory.
Definitely. And then Friday, we get monthly UK GDP data, giving us a snapshot of the UK economy.
So overall, a really packed week. Critical inflation data from the U.S., central bank decisions from the ECB could significantly shift market direction.
It'll be crucial to watch how these unfold, especially against that backdrop of political shifts in Europe and Japan. The interplay is going to define the narrative for a while.
Absolutely. Politics, central banks, economic data, it's going to keep us all on our toes. As we navigate these complex markets, maybe consider this. If central banks really face a choice between helping a weaker labor market and tackling sticky core inflation, which path will they ultimately pick? And what does that mean for investments in the coming months? Something to ponder. Thanks for watching. Don't forget to like and subscribe.